Hello and welcome to Jazz After Dark, everybody. How you doing? I'm going to do it again. Jacob's Pardon. This is not the same night, by the way. I'm recording this on a different night. If you saw last night's video, this is no joke. This is a very, I thought it was very spicy. But if you want to join me here tonight, grab some Gatorade, grab your favorite drink, scotch, bourbon, whiskey, whatever. We have no affiliation with Jacob's Pardon. Just bought it. Thought I'd check it out. It is very strong, but I'm coming at it tonight with a fresh mindset. I've got incredible amounts of data to share with you today. The second best strategy ever in terms of investing in the market. What is it? I'm going to share all the data with you. Here goes. Oh, dear God. Okay, so last night, this got me. I breathed in too hard. Very citrus. Actually, if you like the orange kind of citrus thing. My God. It is so strong. I don't know if I'm like swallowing different or what. Incredibly spicy, but yet orangey, a lot of that orange peel kind of a vibe on there. Yikes. Sorry. It is really spicy. Anyways, if you want to check it out, this is only the 8-year. I'm not sure I'd advise anything else there, but if you like that stuff, check it out and enjoy. I hope you have a drink. You're hanging out with me, even if it's water. That's fine. This is a laid-back class where we talk about, in a more elaborated context, what to do. Tips, tricks, and things like that. If you have any topics, of course, let me know. All right, so what is the best investment strategy ever if we were to line all of them up and say, we just want to know that there's going to be a gain? And then from there, we want to know that there's going to be a gain of some amount. And we just back test everything in history. What is the best strategy? Do you know? I've actually covered this numerous times. The 100% guaranteed way to, and I can't say that, right? We're advisors here. We're not allowed to use that word. But statistically, when I should say historically, if you bought the market, waited 20 years or 30 years, 100% of the time, you would have a gain at the end of that 20 or 30-year time period. So when we rank strategies and analysts and quants look at all this stuff, well, that one wins. But what if you're like, dude, okay, I'm a long-term investor, but I want something better. Do you buy breakouts? Do you buy after they beat on, let's say a company beats on earnings, revenue, and guidance? They call it a triple play or whatever. Do you buy after the market has had a down year of X%? You know what I mean? Like there's all kinds of different things you could do. There's millions of different strategies. Well, tonight I'm going to share the second best. And this is statistically the second best relative or compared to just buying and holding for 20 years. So it's not common. You're going to have to be kind of patient here, but it is technically the second best performing strategy. So let's take a look. This is going to be a lot. Hope you're ready. Okay, so anytime the stock market falls 5% or more in one day, the next year's performance is statistically the best. So let's do an example. We'll go up to the top. Oh, good, you can see that really well. Hold on a second. Whoop, jazzwealth.com. So let's say, for example, 1955. On September 26th, the market fell 6.62%. We then looked out and said, what did the next day look like? Next week and 4 months, next 4 weeks, next month, 3 weeks, 6 months, and year. Okay, fine. Then we found every single time since then that the market has fallen at least 5% in one day. Now, first thing I want to point out is go right here. So if we just drew a line from here to all the way down here, all of that's in the 2000s. The advent of the computer, the ability to make decisions faster. And really, we got to go to 97 to really include the computer here. Look at all the times the market's fallen 5% in guaranteed our lifetimes, right? The people that are watching, at least what YouTube tells us, the people that are watching have lived through this. So it's highly more common that you're going to see a 5% loss in one day than at any other point in history, right? So this is what we did. Of course, this is Black Monday here. Losing almost 21% in one day. By the way, the next day positive, the next week positive, next 4 months positive, the next 3 months positive, 6 months, blah, 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 right? So this gets tricky. Number one, when the market falls more than 5% in a day, statistically, the next year is the second best performing strategy. 85% of the time, almost 86% of the time, it is positive by an average gain of 25.16%. And that's average, right? We look at the median, you got 23.5%. So the difference between the average and the median is very close, which tells you there's got to be only a couple outliers. 89 and 2000, where we saw the next year, there was, in fact, the dot-com bust, right? We actually went through that. We went through the recession of going into 1990. So, okay, fine. But all in all, we have a consistent stream of returns. So down here at the bottom, what I have is over the various time frames, average, median, and then the percent of time that is positive, which is just take the positives or divided by the negatives and you get the positive, right? So the weakest time period is over the next week. You short-term people who see the market fall 5% in one day, it's a tricky one. I'm not sure I would want to participate in only a 1 week time period. I'm not sure I'd want to participate in a multi-week time period. Yes, the average gain is a positive and it's slightly more positive than negative. However, I'd be thinking if we have a 5% loss in one day, I think I'd like to commit some money to the market long term, right? And so that's what I'm trying to illustrate here. Now, funny enough, you get into the 2000s, right in here, and you find that there is basically, and since 2008, there has never been a moment in time since then where the stock market fell 5% in one day and then was a loser within 1 year. Kind of cool to see, I think. So anyways, the reason I bring this up is not because I'm hoping for a 5% down day. Well, am I though? Yeah, I would take it. 5% down in a day, maybe election day or the day after. I don't know. Here we go again. I mean, it's good. It's very good. It's just, it's tough. That's a spicy one. Yeah. If you know Buffalo Trace, it's just above that. And I like it. I like spicy. Anyways, so I bring this up not because I want you to root for a down day, but I want to kind of show when should you be expecting it? So if we look forward here, here is breaking that out, the number of 5% declines in one day, but then we break it out over a month. Really simple thing to do on a spreadsheet. So October has the most amount of 5% lost days by far. Notice that the end right here, this October, November has the big time. Where are we at? We're in November. I'm not saying it's going to happen, but the bulk of the 5% down days happen right before what you might consider the Santa Claus rally and the year-end rally, whatever. We do have March as being a weaker spot, but all in all, this is sort of like, hey, one or two here and there, not a big deal. The bulk of them happen right in this weak spot that we're at right now. So that's the down days. And personally, I like that. I want to buy on down days, weeks, months, whatever. It's fine. We can expand on this now and say, let's go 5% in a week, right? The stats aren't going to be any better because that's the second best. 5% over the course of a 5-day window, things like that. Actually, our research site, jazzwealth.com/research, you can just plug that in. Hey, the S&P losing 5% in a week, show me the forward performance. So it's really easy for us to go back and do that. All right, let's take it a step further. Is it the same on the way up? If the market gains 5% or more in one day, do we tend to see gains build on top of that? I just thought it's only fair. We're only picking on the downside. Let's take a look. So here we go. This is all the data. Same thing, but what we're saying is you have to have at least a 5% gain. Now, again, I would point out right here, we went to 97 before. All but 3 of them have happened since the advent of really the mainstream computer. Like, dude, you're getting a Dell. Remember that? How many people remember that? Just give me just give me a thumbs up. You don't have to say anything. Just in the comment section, just go, dude, you're getting a Dell. Thumbs up. I remember that. And then what was it? The commercial years later was, dude, you're getting another Dell. That's pretty brilliant, right? Anyways, so 5% days here. Let's take a look. So the next day after a big gain, 5% or more, tends to be negative. It's only positive 34% of the time. The next week tends to be negative, meaning we pull back, we settle in a little bit, we digest the fact that we just had a 5% day, only 40%. However, if you go out a year and you're going to chase the 5% gains, right, you got a great chance of success here. And that is, you know how I said the other one was the second best performer? This is really just the drift of the overall market. Like they say, you never short a dull market. And that's because the market has a natural upward lifting drift. And if we just say we're a buyer at any one point, the natural drift higher takes us there. And you know why that is? It's not because it's rigged or something like that. It's because what do we hope for? In the S&P, earnings continue to grow. Not everybody. Some people have bad years, but earnings continue to grow. If earnings continue to grow and companies are finding more efficiencies inside of their process, especially with AI coming up, then you go, well, then that means you made an extra penny per share. That means your stock is worth a little bit more. And that's what drives that upward drift there. So anyways, going back over to this one here, if you have a 5% gain in the market, in the very short term, you don't normally want to chase that. And you've heard me say on the closing beat numerous times, like, that's a big move. I'm not sure I want to pay above average prices. The market tends to settle in and take a little bit of a break over that short term. Now, if you go back and look at those days, by the way, the November 2008, there is 1, 2, 3. There is a December 2008. There's two October 2008s. Notice that a lot of them are right there. Go back one day and you're going to find that day before was a big down day. Not quite 5%, didn't make the radar there, but you've got down days beget buyers that want to step in and play along. Now, the tide shifts just a little bit here, right? So the biggest amount of 5% gains by month happens in the beginning of the year. We do still have the October, November, but what is this going to be? If we plotted these next to each other, those big days are just simply reversal days from the days that were down some amount, or maybe multiple days lost 4 or 5%. And then we have this recovery rally. So that's what you're seeing in there just a little bit. Anyways, thought that'd be cool. Lastly, I want to share this with you. If you were to buy after large gains or buy after large drops, how would you fare over the long run? Well, the green is the next day after a 5% gain. And we're just plotting it from the chart before. So you average a small loss. The next week, a small loss. The next 4 weeks, a slight gain, but not as good as if you were to buy the dips instead of buying the gains. Over the next 3 months, still positive, but not as good as if you bought the dips. Over the next 6 months, it starts to flatten out, and then you get to the point where, hey, we're just participating in the market rallying and rallying and rallying, and this is all good. The moral of the story is, even though it's really hard, this is just one day. If the market falls 5 or 10% in a week or a month or just a year, I don't know, whatever, when it has those pullbacks, that proves to be the outperforming reason to buy over the long run. And I point this out now because the market's higher. I have your attention, right? I'm the sloppy guy that's just sitting here trying to get this down. I'm not gonna. But if I have your attention now while the markets are calm, great, you have something to study, something to remember. If I try to grab your attention when the market is falling, you're already panicking, right? So I do this with clients too. Let's talk about the market falling before it falls, and then you're ready with that data when you're not emotional, right? So hope that helps. Just wanted to point that out. It's a lot of data to share with you in such a short amount of time. Again, if you're interested, I have nothing to do with them, and this may be the least one that I would recommend. It's good, just too much for me. Call me weak, whatever you will. It's just not my style. But feel free to check it out if you want to learn more about a really spicy whiskey. Anyways, enjoy the rest of your evening. Thank you so much for watching, by the way. If you would help me, if you're not already a subscriber, you don't even have to turn the bell on. Just hit subscribe. Makes us look bigger, gets us excited. We're like, oh no, let's make a bunch more videos. People love us. I would appreciate that. Otherwise, thank you for considering that. Have a great rest of your night. Adios.